They wanted silence. That was the expectation. That was the assumption baked into every risk model on Wall Street this week. Christmas Eve is supposed to be a non-event. Half days, skeleton crews, traders mentally gone, phones unanswered, decisions deferred. Markets are supposed to sleep. But this one didn't. And when markets move on days they're not supposed to, that tells you something is wrong beneath the surface. Today was not noise. It was exposure. It's Wednesday, December 24th. Historically, the quietest trading session of the year. Volume collapses. Liquidity dries up. Nothing meaningful happens because nobody wants to be the idiot who moves a market during the holidays. Except today, silver exploded higher. Not drifted. Not crept. Exploded. Up nearly $4 in a single session. Over 5% in one trading day. In a market where 5% is supposed to take weeks, not hours. That's not enthusiasm. That's not bullish sentiment. That's panic. This was not buyers chasing upside. This was sellers running for the exits. For months, the story was discipline, control, suppression disguised as stability. Every rally faded. Every breakout stalled. Analysts called it healthy consolidation. Banks called it managed risk. What they didn't tell you was that the risk was piling up. Short positions stacked on top of short positions, hedged against models that assume calm, assume liquidity, assume time. Today, time ran out. $70 was supposed to hold. It didn't. 71 was supposed to slow it down. It didn't. And once the price pushed into the low 72s, behavior changed instantly. Offers vanished. Depth evaporated. And the only thing left in the book was fear. Because Christmas Eve creates a unique kind of terror for anyone holding leverage. When the market closes, you lose control. You can't adjust, you can't hedge, you can't react. The world keeps moving while your position is frozen in time. If you're long, that's fine. Upside risk is optional. If you're short, upside risk is fatal. So the risk manager stepped in. Not tomorrow. Not next week. Today. Flatten it. That's the instruction. Not because the price is wrong. Not because the thesis changed. But because the calendar changed. If bad news hits while markets are closed, shorts can be wiped out before they can respond. Margin calls don't care about holidays. Liquidations don't wait for permission. So they bought. Not strategically. Not patiently. Violently. Market orders. Any price. Get me out. And in a thin market, forced buying doesn't climb a ladder. It punches through the ceiling. That's why silver didn't pause. There was no resistance because there were no sellers. Everyone who wanted to sell already had. What remained were trapped positions. This is what capitulation looks like in real time. And then there's gold. Gold didn't scream today. It didn't need to. It simply crossed a line that cannot be uncrossed quietly. $4,500. Gold is not traded like silver. It moves slower, heavier, more deliberate. When gold breaks a major level, it's not because of speculation. It's because of confidence loss. Gold is the mirror the system doesn't like to look into. It reflects currency weakness without opinion. It doesn't lie. It doesn't spin. At 4,500, gold is telling you the purchasing power of money has deteriorated far more than officials admit. And silver is responding to that truth. Look at the ratio again. Gold at 4,500. Silver just over 72. That ratio is still historically stretched. Which tells you this move is not overextended. It's unfinished. The machines know that. They don't trade narratives. They trade imbalance. Gold breaks out, silver lags, silver must catch up. That trade is mechanical, emotionless, ruthless. Add that flow on top of forced short covering and thin liquidity, and you get exactly what we saw. A vertical candle. And now the psychology flips. Markets don't move in straight lines, but they do move in phases. First comes disbelief. Then acceptance. Then urgency. Then panic. We just crossed from acceptance into urgency. 72 is no longer shocking. It's the new reference point.
The question is no longer can silver do this, it's how far does this go before something breaks? 80 is no longer fantasy. It's a nearby waypoint. And that's dangerous. Because when round numbers come into view, momentum traders arrive. They don't care about supply chains or macroeconomics. They care about charts and velocity. Silver just printed the kind of move that screens for momentum strategies, which means more buying pressure is coming, not because of fundamentals, but because of structure. Now layer in the calendar. We are entering the most misunderstood week of the entire trading year, between Christmas and New Year's. Most people think nothing happens. They're wrong. This is when liquidity is weakest and price sensitivity is highest. Senior traders are gone, risk desks are understaffed, market makers widen spreads or step away entirely. It becomes an echo chamber. A single large order can move price more in this week than in an entire month of normal trading. And silver is one of the thinnest major markets on Earth. If a pension fund reallocates on December 20th, if an Asian buyer steps in when U.S. desks are closed, if a sovereign fund quietly adds exposure, there may be nothing to stop it. That's how gaps happen. And while paper markets thin out, the physical market does something even more revealing. It shuts down. Bullion dealers don't like volatility. They like spread. They like predictability. And right now, predictability is gone. Selling physical silver into a weekend with no hedge is suicidal. So they pull inventory, they delay shipping, they quietly stop answering orders. Officially, it's Christmas. Unofficially, it's fear. This is the moment when fiat fails its basic function, exchangeability. You have money, you want metal, you can't complete the trade. That's not a market, that's a warning. Meanwhile, industrial buyers are waking up to a nightmare. They don't speculate, they budget, they plan, they sign contracts months in advance. Those contracts just blew up. Solar manufacturers, battery producers, electronics firms. Silver isn't optional. It's not a trade. It's an input. At 70 plus, cost models collapse, margins disappear, and production schedules don't care. So procurement teams panic. They stop waiting for dips. They stop caring about spot. They go off exchange. Private supply agreements, guaranteed delivery, fixed tonnage. They're not trying to beat the market, they're trying to survive it. And every off-market deal removes silver from public circulation, which tightens the squeeze further. At the same time, miners are experiencing something extraordinary. Their costs are fixed, their revenues just surged. Every extra dollar above 70 goes straight to the bottom line. That's explosive, free cash flow. But equity markets haven't fully priced that in yet. They're still skeptical, still anchored to the idea that this move won't last. That skepticism is fuel. Once belief flips, mining equities don't rise, they reprice violently. That's the second leg. And looming over all of this is January. The reset. New allocations, new inflows, new performance benchmarks. Fund managers who missed silver this year cannot ignore it next year. Even a symbolic allocation forces buying. 0.1% sounds small. It's not. It's billions. That capital will enter a market already starved of supply, which means January doesn't start a move. It accelerates it. Before then, expect chaos. Tax selling, window dressing, random dips that mean nothing, sudden volatility that scares people out of positions they shouldn't have exited. That's the final test. Because the real risk now isn't downside. It's absence. Being out of the market while it reprices overnight. This is why squeezes reward patience and punish cleverness. You don't trade them, you survive them. So here's the reality. What happened today was not an accident. It was not seasonal noise. It was not hype. It was the first visible crack in a structure that's been stressed for years. Shorts broke. Liquidity vanished. And price escaped containment. This is no longer about silver. It's about trust. It's about currency. It's about the slow realization that paper promises fail when stress arrives. 2025 was the ignition. 2026 is the acceleration. And if you're watching this now, understand this clearly. You are not late. You are early to the repricing phase. The silence they wanted never came. The market spoke anyway. And it's just getting started.